Thanks for joining us for the Member Excite presentation. The Member Excite presentation is informative, interesting to the audience, and showcases the strengths of the presenter as an entrepreneur and their area of expertise. It's not a sales pitch, it's a 10-minute educational and insightful exploration into what they do. And of course, it's exciting.
Ladies and gentlemen, please welcome our BX Excite presenter today, Alan Hanchoy from Targeted Business Services, to present to us on tax planning. Ladies and gentlemen, please put your hands together for Alan Hanchoy.
Tax planning. You can do tax planning 365 days a year if you're self-inclined. Most people aren't, but it's all about negative gearing, structuring it so you can split your income, and using the changes in tax law to benefit you. But mostly people do tax planning right at the end. Some don't do it at all. But if you did it before 30 June, you're okay. The idea is once 30 June passes, it's too late to change anything. So, it's all about just working out what your taxable income is and how we're going to reduce it. So when we do tax planning, we do individuals and we do businesses. So individuals, we estimate the tax and then we work out strategies to minimise it. A lot of it's more about super, deductions and things like that. There's not a lot you can do about individuals. But businesses is where we concentrate. But other things about individuals is like you could catch up superannuation. So the law changed back in the 1st July, or from the 1st July 2019. If you haven't contributed super from back then, you could top your current super up. So say in 2019, I put $10,000 in the super, and the limit was 25. And this year I made a huge profit. Well, I could bring that 15,000 up to pay this year and claim the tax deduction. And 20, if I only put 10, I could put another 15. And then last year, another 15. So that's 45,000 plus the 27 this year. So I've just reduced all my tax. And a client is doing that at the moment. He's putting 94 in for himself, 70 in for his wife. They made a $300,000 profit on their sale of a house. So his tax is down to $50,000 now of taxable income. So we've saved all that money, which is great. So that's individuals. There's tools you can do. You can prepay subscriptions up to 13 months. And if you've got a rental property, you need to get a quantity surveyor's report to claim the biggest deduction. Okay. The other thing is to get defer income, but it's hard to do that as a salary and wage earner. But if you've got a rental property or other investments, you could defer, like say you got a term deposit. You could say, okay, it might go 6 months, but it then matures in June. Maybe go 7 months and put the interest into the next financial year rather than pay it this year. Especially if your high income's high this year and it's going to be lower next year. So there's little things like that. Whereas in businesses, we use trusts and companies to minimise your tax. We split your income. We use a company as they call it a bucket company, to put money from business into the bucket company, and you only pay 25% tax, as opposed to paying 47% in your own name. Little things like that. And then when tax rates change, you look at that as well, but they've all come down to 25 now, so that was a few years ago we did that. Investments. So as I talked about, negative gearing, you get your depreciation schedule, and you look at, in your rental properties, the repairs as opposed capital expenditure. So if you can classify as a repair, you can claim it now. If it's a capital expenditure, you've got to write it over time. And they also look at the capital gains if you have a rental property. Who owns it? If you buy a rental property and you're trying to reduce the higher income person's taxable income by having losses in their rental property, what happens in 10 years' time when you sell it and you make a huge capital gain? You've got to think of all those things when you buy the property, at the time of buying the property, not when you're going to sell it. So being a person with a bit of personality, not a boring accountant, but you've got to think about tax all the time. It's always front of mind for me. That's why accountants are boring. That's all I think about is tax. talk about super contributions being bringing forward. But you got to in relation to that, you've got to have a balance in your super fund of under $500,000 when you contribute. So there's rules and things around that. Other things you're going to do, as I said, prepayments, bring forward expenses. So if you need to buy all those consumables, buy them now rather than the 1st July. Accelerate depreciation. If you really need to buy some equipment, buy it now before 30 June so you can claim it this year. Don't go buy it the 1st July, have to wait another 12 months to claim the deduction. So it's timing as well as of when you get an deduction, because you take into account the time value of money, spend to do it now, because 12 months' time, it could be like in the World War when the German mark went down to worth nothing. You know, you carry a bucket, it wasn't a wheelbarrow worth of bloody money just to go buy a loaf of bread or something like that. Stupid. You can accrue wages. You can accrue wages now. So you can say, okay, I'm going to claim a tax deduction for wages now in the company, but the person you're paying the wages to doesn't show as income until next year. So this is a little trick you can do that. That's a good one. I've done that with a few times with a client who gets a bonus. He gets a $100,000 bonus every year. We split it over a few years and we've saved tax doing that. Delay invoicing. Don't invoice in June if you can help it. Well, watch your cash flow, because if you delay the invoice, you're not going to get paid. Well, that's going to put you out of business. But you really got to think about your cash flow, but delay invoicing, saying we're going to do it next year. Splitting income where possible. You've got to take into account personal service income and splitting income. If you're a personal services business where you provide all the services, you don't have any staff, you don't supply any materials and stuff like that, you can't split your income. But if you can split your income, that's the best way of doing it. I've saved thousands of dollars for people by splitting income. There was a draft ruling came out on the 23rd of February, and being a boring person, I remember that date for some reason. But the draft ruling was that in trust distributions now, you used to be able to just do the distribution on paper. Now you actually got a cash flow through, which makes it a bit harder to split income with people. But I thought of a way around that. And what they used to do years ago, people used to have offshore companies. And so they get income offshore. Bit of a tax scam, really, but they did that. That was before I actually started the business, but I heard about it. And what they used to do, they used to have a credit card in that account over there, and they spend all their money on the credit card. So it never came back to Australia. No one ever knew about it, and they could avoid tax as opposed to minimise it and still spend it. So I've thought about using that process in relation to cash flowing the distributions from trust. So you're still giving the money to the person, but you get it back, because if you bring it straight back, the tax office will see it and they'll say it's a sham and you can't have it. Okay, talk about invoicing, prepayments we've talked about, consumables, as I said, buy consumables now. If you buy 3 months worth of consumables, I wouldn't buy more than that, but 3 months and bring it into this year, accrue any other expenses, maximise your super. Super is probably the biggest deduction, because you're getting a deduction for investing in yourself. And you might get a 47% deduction in your name or through your business, and you only pay 15 cents of the super fund. So, how much are you saving? 32 cents. 32 cents of the dollar is better than you, especially if you're getting putting $27,500 in. Can't work that out again, so. You're an accountant. Oh, I don't remember figures. I don't do calculations yet anymore. Getting a bit old, the calculator comes in really handy. So the other main things I talked a bit before about the trust, splitting income. If you can split income legally, that's going to save you heaps and heaps of money. I've saved people up to, I think the maximum I save now is about $90,000 by splitting income with other family members. And that's my boring presentation.
Well done. Okay. Are there any questions for Alan?
Yeah. So, to reduce your income, you can purchase, say, for example, a vehicle, right? But with the current market, you're waiting 12 months, say, for a vehicle, if you were to pay, ask for invoice paid in full before the end of June, even if you're not taking delivery for 12 months, does that, because you paid the invoice in full, does that count for this year?
If you've got an invoice and it shows that you've actually paid it, technically you haven't got it, but if you've actually paid the invoice, you've incurred the accrued expense. I think that's as I go along in my head, but yeah, because you've incurred the actual expense, you probably can.